Put your business card in it when you're done. Donate it back. We'll shout you out for doing that. We really appreciate it. So that's a lot to cover. Upcoming events, December 20th, we have our luncheon. If you guys haven't been to our luncheon, it's every third Friday. It's at the rail car in the back party room. Fits about 45 people. We've been at capacity the last couple weeks or months, and so thank you for that. It's open to everybody, members and non-members. It is a networking group, so when you guys come, it's meet, mingle, and talk about your successes. Everybody's welcome. You buy your own lunch. I do my spiel of what the upcoming events in, but it's not about me. I'm not an event speaker. We don't bring any speakers in. We want every person in the room to talk about what they're looking for in the business, what's happened in the last 30 days, and a personal win. Who's come to our networking lunch? Do you guys like the method that we do it? Okay, so it's different. I mean, I'm part of different networking groups, and I hate the fact that you can only have one realtor, insurance agent, this, and this. It's all welcome. And if that one person that is in your group sucks, you're stuck with that person in your networking group. Well, this is open to everybody. So come enjoy it. I'm on fire today. I was on vacation. I got to go out with Owen for his birthday in Las Vegas. We had a good time. So happy birthday, Owen, again. I got to go with my wife to Minnesota, go see a Vikings game this weekend for us on a date week. So I feel refreshed. So I'm on fire today. So January 7th, we have Jeff Beals coming to speak. Jeff Beals speaks every single year at our group, kind of like how Jordan does. And Jeff Beals with the Grow Omaha radio show. I think it's the biggest radio show now in Nebraska. It's on AM radio, and he talks about growth, development, everything happening in Omaha. So write down the questions. You have an area of town you're looking to invest in. What's happening in that part of town? You see some blighted properties. Bring that up. Write it down. Bring in your book. You want to know what's going on in a new build? Bring it up. There's things and developments that are happening that are going to benefit the future properties that you buy for your rentals. Take advantage of that, because that's what it's all about. So bring your questions to Jeff. He's gonna have his slideshow, tell you everything that's going on, but then it's all Q&A that presentation can be 30 minutes or it can be 2 hours depending on how many questions you have. Jeff is awesome, and there's nobody like him when it comes to speaking. He actually speaks speaks worldwide, all around the world, to companies about growth and development of their businesses, but he is focused in Omaha. And I think you guys have a great event to attend there. Also, probably the biggest event of the year for us. Does anybody know who Jason Dries is? So Jason was just on our podcast episode on Wednesday. Jason's like a business coach for the stars. If you guys know Brandon Turner from Bigger Pockets, he's Brandon's personal coach for the last decade. This guy is energetic, exciting, fun, and extremely intelligent. And the guy, when we were about to podcast with him, we're like, oh man, where are we going to go with this? How are we going to bring some excitement in it? And he has great conversation. If you're on the fence on coming to this event, listen to that last episode of the podcast on Wednesday and make your decision. You will not regret coming to this one. I personally just signed up to go through his coaching program. I'm super excited. I just did a 6-month commitment, and we'll see where it goes. I haven't had my first session yet, but I'm going to have it next week, and I'll give you guys feedback as it goes. But this is definitely not the event to miss. So biggest name we've probably ever brought in. And so that's going to be March 4th. February speaker, we're just about to lock that down, so I'll announce that here in the next week. And also sponsorships. A whole bunch of you guys just signed up. I mentioned this before. I think last time I counted, we have 51 sponsors between local and national. They provide at least a 10% discount. Some of them offer up to 50% discount. And the discounts are for you guys. So if you've got a new property, the idea is that you have everything that you need in your business, even if you're brand new and you know nobody, you just moved to Omaha, to be able to do a flip or renovation or Airbnb, or everything you need. Now, we just added some new people and we got some new renewals too. So we just renewed Ben Harrell from Safe Exit. Ben, you here? So Ben has been with us for 3 years. And if you need an egress window in your property, he's going to do it. He's going to add value. So when you do that, it's an instant value add. It isn't a maybe, it is. So thank you for re-signing with us, Ben. Appreciate it. We'll do JM Real Estate Capital just renewed in the back for their, I think, 3rd or 4th year now. So thank you for that. And new sponsor is Magic Door. We just did a webinar with them. If you guys, I kept the flyers out there so you could see it. If you missed that event, Magic Door is a property management software, and they do 1 unit. They can do 1,000 units. On top of that, also, if you have short-term, mid-term, or if you are a property manager needing new software, they can work with you. The prices start off at, I believe it was $1 per unit per month, and it goes up to $3 max. And it's all AI driven. We also did Casper Sogard. We did an interview with him, I think about a month and a half ago or so. And he created the AI for Amazon. He also created the ad-based system for Hulu. He had investment properties. He wanted to create something, so he created an AI system and then created the management system around it, because he said every management system is already created and they want to bring AI into it. So he reverse engineered that. I went through the onboarding process on a property that I was about to bring on. I put it under contract, so I had to back off. So now I'm going to try another one, but they're going to use that system most likely. But it is extremely intelligent. It takes phone calls 24 hours, and it will reach out to all your vendors also for you. So it's pretty sick. If you want to see that video, it is on our REIA Radio YouTube channel. Definitely check it out and watch it. I think it's about a 45-minute watch. And there was I think we had about 40 people on there, so I appreciate the guys that jumped on it, guys and gals. Also, update for REIA Radio podcast. Again, we just had Jason Dries. Monday, we do our real estate rundown. Check that out. And then tomorrow, we release a live event because we were out of town partying, and we didn't record a new episode. But we did Mike Wolf. Mike Wolf spoke about a year ago, and we thought he was fantastic. He's a traveler, does not have a house. He has hundreds of single-family houses around United States and manages them completely remotely. And so check that out. But without further ado, my jaws, I don't talk this much, just so you know, Jordan, so I'm kind of at my max here. But tonight, we're fortunate to have a true expert in the that's terrible. Tonight, we're fortunate to have an expert in the complex of ever-changing world of taxation and financial planning. Jordan Downey is a partner at Frankel and is a trusted advisor in business. Jordan specializes in helping businesses and individuals navigate taxation, business planning, and it manages the acquisitions, and also real estate strategies. With a master in taxation in the Golden Gate University and a degree from the University of Nebraska, his knowledge and expertise are unmatched. Beyond his professional achievements, Jordan serves at the UNO Accounting Advisory Board and is active in Frankel Marketing Committee and is a proud member of both AICPA and NSCPA. I don't even know what those stand for, but you have to tell us. Jordan has been doing my personal taxes now for 2018, I think we started. And I don't think I've had to pay out money since he's stepped in, but prior to that, I did. And the reason is he found things that were not getting done. And it was other investors, which I'm not going to name drop, but are in this group and sponsors of this group that referred me to work with Frankel. And one of them personally told me that the first time that they worked with him, you saved them over $100,000 in taxes on your first year of working with them when they transitioned to you. Yeah, things that weren't found on a very large portfolio. So I'm not making it up. That's what they said. And so without further ado, can you welcome Jordan Downey?
Test. Okay. Sibilance. Anybody get that reference? All right. So, listen, I'm really excited to be here. I sort of was dreading it like a month or so ago, and I'm like, I don't know what I'm going to talk about. I've talked a year ago. There hasn't been a lot of changes. But honestly, I think when it comes to tax, and really, we'll kind of get more into it, but it's really about being efficient with your income, knowing when you're at, doing good planning, and basically trying to keep more of what you make. There's a lot of different ways around it. Ted mentioned we were able to save people money, but a lot of the times it's just doing proper planning, knowing the laws really well, where you can, where you should position yourself and all that. Like we're not putting clients in bad situations or anything like that. We just know the laws really well and try to provide value to every single one of our clients. And with that, we have a really good team. We have a booth here with some of our very talented CPAs and staff that, are, without them, like I couldn't serve as many clients as we do. They do really, really good job in helping just manage our clients, helping just looking through the details and making sure that we understand where we're going. And so it's really good to have a team like them. Frankel in and of itself, we've grown quite a bit since 2019 when we were at TED. But we're a full service accounting firm, like meaning we're doing everything from, taxes and audit and assurance services like most CPA firms would. But then going on to CFO for hire, bookkeeping services, payroll, down to, helping with specialty tax services, R&D, and connecting the dots on doing, cost segs, and a lot of that stuff that we'll kind of talk about here as we go. But, there's a lot of different things to the financial world, and so it's almost like we're, a financial boutique where you can kind of pick and choose what service you need. And so at the end of the day, we're here to help. So we're going to go through a few things today. I really want this to be for you guys. I've picked out a few things. Last year, it was, fortunate for everybody that there's a blizzard, so you didn't have to come out, and I just talked in front of a camera for a lot of the time. Was pseudo hoping for a blizzard, but no, we're good. But I tried to, from what I talked about last time, we went into a lot of minutia and different details, and so I tried to keep it a little bit higher level this year. And so we'll touch base on a lot of different things, really concentrating on a lot of different real estate activities, obviously. But the tax world's complex, and we can go off into a lot of different tangents. And so really, I want this to be for you. So if you have any specific questions, speak up. Raise your hand. There's a mic there for everybody to come and talk to. That'll add a lot of value to everybody around, because I may think everybody understands a concept, but asking a question, there might be half the room doesn't know what I'm talking about. That and if you don't interact with me, then I stand up here like a professor, and my tone just gets very mellow, and I never really change it, and I just keep talking, and I think people are listening, but maybe they're not. They're just looking at their phone. Kind of goes off into that realm. So, without further ado, let's look at some slides. I'll start spouting out some information. We'll kind of go from there. But, okay, so there's year-end planning for real estate and a little bit more. I put this up here, and all these slides, we can send these out. I know they're going to be kind of hard to read at times. But I put this slide up here because these are the brackets that we are playing with for the current year. And so what's important about that is understanding where your income is, what bracket you're falling into, and where you can do your planning. A lot of times if I have clients come in and they're hey, I want to do a cost seg, but your income is in the 10% bracket. So you don't need to drive your income down anymore. Let's do some efficiency planning and plan for, paying a little bit of tax now, but then getting a better benefit for that deduction in later years. And so you really need to know where you're at. And also, as part of this, you have your ordinary income bracket, but, you'll learn with tax, with government, they are incentivizing you to do certain things, when the Tax Cuts and Jobs Act came out and they gave you 100% bonus depreciation, interest rates were low, buying real estate, depreciating it out, getting losses, flipping it, turning it into more real estate, so forth. That was pseudo incentivized by the government in a way. Same thing in here. When you look at the brackets, you see this capital gains bracket here where there's up to, for married filing joint, $94,000 of adjusted gross income is at 0%. And so, if you can plan properly and get your brackets and your income into those criteria, then you can really reduce your tax rates. And that's a lot of what, when you're doing good planning, particularly at year end, that's what you're looking for. Like, it's not about paying no tax. It's about paying the least that you're legally obligated to and being super efficient with it at the same time. And this is where, the investments, the long-term holds, holding it for a year and a day and getting that 15% versus ordinary, those are like simple strategy things, but like, if you don't know what your situation is, then how are you supposed to know where you're gonna end up? And if you don't do the planning before year end, then you've basically made your bed. There's very little we can do after the fact. There are certain things that we can make elections for, and we'll kind of talk about it, but that's kind of what we're playing with. And so you really need to just understand that, because that's kind of the base concepts. There's other like incentives with credits and whatnot that we'll talk about too, but at the end of the day, this is kind of what it boils down to. Let me go to the next slide. Do it again. Okay, one more. Okay, so we're going to talk specifically about real estate activities for a few. Now with this, like, it's good to understand, real estate has a lot of different aspects to it. You all aren't doing just buy and holds. There's flips, there's wholesales, there's, you're doing some construction, maybe you're a contractor, to a real estate agent. All those different activities are treated differently when it comes to how the IRS perceives it, looks at it, defines it, and then taxes it. And so passive activities, everybody wants that mailbox check, monthly check, which would be a true passive, even though we all know it's not necessarily truly passive at the end of the day. But passive activities in and of themselves with real estate, when you are renting them out for more than 7 days, the IRS is going to say, well, it's per se passive. Or if you are investing in properties and you're not spending any time on them, then that's going to be passive as well. Versus if you are continually working in a property, it's short-term rentals, your real estate agent, your wholesaling, your flipping, those would fall into an active category. And why this is important is because when you create losses in passive activity, it has some pretty strict limitations on how you can actually utilize those losses. If you would go to the next slide, please. As we kind of look through this, I thought this was a pretty cool kind of flow chart as we kind of just look through what is defined as passive. And so you can see there's some hours requirements. Do you spend more than 500 hours on the activity? Do you spend more than 100 hours? Because there's different types of passive activities. And then you can kind of go through and it'll help you determine if it's passive or non-passive for you. Part of the importance of understanding the passive activity limitations is also the elections in order to make it not passive. If you go to the next slide. Let's go one more. Okay, so how do you make things not passive when they're per se passive, like long-term rentals? You can become a real estate professional. Now this, I think the room all has heard this term before, being in a real estate-centric group. But understanding that in order to take a activity that is a longer-term rental that is per se passive, in order to use that against ordinary income, to use those losses against ordinary income, the only real way to do it is to become a real estate professional. The other kind of, there's kind of another rule that comes along with an exception called the mom and pop rule, where you can take passive losses against your ordinary income. That comes into play if your income is below 150,000 for married filing joint, and you can take up to $25,000 of losses against it, against your ordinary income. Otherwise, if you're above those limits, you can't take any passive losses against your ordinary income. They all just get suspended, and they'll just roll forward year over year. They don't go away, but you won't be able to utilize them until you have passive income to offset that passive loss. So they'll kind of sit in their own little bucket. If you become a real estate professional, then you can take those passive losses and you can offset your ordinary income without any limitation. One question that I get often is, if I become a real estate professional, I have $200,000 of passive losses sitting here, so I'll get to use those. But that's not the case, actually, because you were passive in the years when those were passive, so it's just in the year that you actually become a real estate professional. In that year, any losses in that specific year can be utilized against it, but everything else remains as passive. And so you kind of have to understand that. So you can almost screw yourself over a bit if you create a bunch of losses and become active real estate, but then you have a bunch of passive stuff sitting there. Like the buckets that they'll sit in, you might actually have suspended losses that you don't get to use because you became active in that current year, and they're treated differently. And so you kind of just have to understand your situation. The cool thing about it is with the real estate professional, it's an annual election. If you meet the criteria, you go through it, you can make this election. So does anybody know here, like right off the top of their head, what the hours rule is for real estate professionals? 750, right. So do you have to do 750 hours on just one project? So the answer is no, right? How do you go about combining the hours on all the different projects in order to meet the actual 750? Good answer. You have to make an election. So every year you have to make this election on your tax return. It's actually a physical statement that sits at the back of your return that says under Rev Proc, blah, 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 we are combining these activities to become a real estate professional. And so you have to have that on there. And so you can't just meet the hours requirement. You also have to go through the process of making the election, combining everything, and doing that. So it's important to have, if you're planning on doing that, your advisor on board with how you're going to do that, and support all the hours, one, but then also he has to do something, or that individual has to do something as well as far as attaching the actual statement to make the election. And it has to be done annually as well. The IRS always comes back, and like when the 750 hours goes, like you're supposed to keep what's called contemporaneous records. And so basically a log of all your hours and what you were doing and how it was associated with real estate and in order to qualify for it. So here's a good slide here. So the 750 is listed there. One of the things that comes up on occasion is I work for Thrasher, we'll say. So I work for Thrasher. I'm obviously working on real estate stuff, so I should be able to count those hours. Well, unfortunately, the IRS has a provision that says if you don't own at least 5% of the company you're working for, even though it's in real estate, those hours don't qualify. And so you have to have ownership in the real estate that you're actually working on. It doesn't just, just work for a real estate company as a W-2 employee, have no ownership, those hours will not qualify. Clear as mud? All right. Okay, so when you look at the hours to qualify for this, there's a court case that came through, and I am a tax guy, so I do like to look at court cases, so I'm gonna make you join the fun. Let's go to the next slide. So this is a somewhat recent case, about 10 years ago. But basically, a married couple had 7 rental properties, thought they were doing everything right. One worked, one didn't, so they were kind of checking the box. But they didn't keep records of anything. They just took a bunch of losses, basically. And at the end of the day, because they didn't track those things, all the losses got denied. They all got suspended. They didn't go away, but they weren't able to use them, so they got hit with a tax and an underpayment penalty and interest and all those other things. So really, like, you have to keep good records in order to make that election and to support it, to back it up. Okay, so one of the things that historically, and this is obviously kind of a newer with all the Airbnbs and VRBOs and basically the short-term rental stuff. Short-term rentals, you would think you are providing a real estate service, that you're renting it out, you're collecting rent from somebody. But the problem is what the IRS says is if you are renting on average for 7 days or less, then you're not necessarily providing a real estate activity. You're providing you're providing more than that. And so they actually say in our next court case, if you will, they come in and they say, well, this couple used an inn, essentially, that was short-term rentals, and they used those hours to qualify for the $750, and they were trying to say that short-term rental activity was a real estate activity and should qualify. Unfortunate for them, the IRS ruled against them. They lost, and it kind of made this precedent that the short-term rental business, those hours, they do not qualify because you're providing more than just a rental service. You're providing, you're changing the beds, you're providing a bunch of different other things, substantially more than just a place for somebody to sleep. And so those hours don't qualify, which actually goes back. It's kind of interesting as, I've been around, I'm getting a little long in the tooth, but this was not something that we thought was the case years ago. So the advice was to start, do some of that in order to get more hours in what you're doing. But unfortunately, in the last year or so, this court case came out and the IRS sided against them. And so now we have to shift our planning to adhere to what the IRS is telling us to do now at this point. And so you can certainly, your facts might not be the exact same as this couple's, and so, but the problem is they've already set a precedent for it, so you have to make sure that you are covering your bases on what your position is and how you're filing your taxes and stuff. So it's important to stay up to date on some of these things because it does change over time. Go to the next slide. Yeah. Oh, tisk going.
This thing on. Check. Oh, wow, I look bad. My question is on the 750-hour thing. If you're already a full-time real estate investor, do you need to worry about proving that every year? Like, do you have to document, like, today I drove around and I saw a rental property or a potential purchase that I was going to make? Do you have to worry about that, or is that you're good?
I would think you're good in that situation. I mean, all of these are going to come down to facts and circumstances. And so, yeah, like a lot of the plan, like, yeah, you're a real estate agent, you're going, you're showing homes all day, every day, you know, like it would be extremely hard for the IRS to prove that you aren't a real estate professional. But you still need to, you know, make sure that all your facts and circumstances line up in that line. And so if at some point you're getting a W-2 for, I don't know, some development project you're doing or something like that, well, maybe the facts change a little bit to where you need to make sure that you're documenting what you're doing on this side, and that you have ownership there, so you're not, you know, so you're able to count hours on what you're doing on the other side as well. You still have to make like the elections every single year to combine things, because, you know, each one of those, even though you're a real estate professional on the agent side, we'll say, but you own a bunch of rental properties here, all those rental properties are still separate until you make the election to combine it into the group that, you know, then makes it active. So you're active here, but you'd still be passive here unless you make the election.
Okay, I think I understood part of that. So is there like a journal or a log that's a commonly accepted format that if you got audited, you're just like, here you go, bro, and you throw it at them and, you know, watch them riffle through it? Or have you seen like all different kinds of stuff when you're going through people's papers that are acceptable and usable?
So, I mean, some of them are easier than others. Like, you know, in your case, like, yeah, if I have an agent, they own a couple of properties, like, it's really easy. Like, you don't really have to prove much because they're doing it all day, every day, everything lines up. It's not a risk. It's when you get into the more riskier ones where you're like, I don't know if I'm gonna actually meet 750. So it's like, well, you better have like a timesheet that's saying, okay, on this day between, you know, these times, I was at this property doing X. And so, and then, I mean, that's basically what they want. They want a time, a date, what you were doing, how long, and like what the purpose was. And so and they'll let you kind of build that in a sense. But the problem is like when you get audited, if you instantly give them the paperwork, like, yep, here it is, got it, they're less likely to ask more questions. If you take 3 months and you've recreated all this stuff and it like, it's in like weird, you know, 1 hour increments for everything, well, they're gonna ask a couple more questions probably.
Good, okay, good. That answered my question. Okay, thank you.
Perfect. All right, so, hey, so we're talking about passive activities, and you know, the whole concept of getting passive activities become active is because you are creating losses inside these passive activities. Now we all know like they're not necessarily real losses, but like how do you do it? You're doing it through depreciation. You know, you're expensing an asset that is appreciating over time. And we're doing it in a certain way, whether it's, you know, through some of the repairs, whether you're cost segging things, bringing more expenses in than with the depreciation and improvements to the property. So as you're creating that, just understanding the buckets that we're dealing with that the IRS is allowing. So, you know, in general, I kind of put a bunch of different kind of, well, the main things like 39-year life is commercial property, 27 and a half years all residential rental, 15-year for, you know, sidewalks, land improvements, and qualified improvement property, which is a commercial aspect, non-structural. And then 7-year life for office and 5-year for vehicles, computers, appliances, carpet, so forth. And so those are the buckets that we get to work in. And so, you know, we're gonna use those to our advantage as we kind of go through the process of buying a property, improving a property, and, you know, depreciating, expensing the same property. Next slide. When we carve out all of the assets that we're buying into those lives, we are provided that anything under 20 years or less on those lives, we can use what's called bonus depreciation. So bonus depreciation has been historically 100%. It was 50% at one time, then it went to 100%, and now we're on this kind of staggering, weaning ourselves off of bonus depreciation from what the TCJA, the Tax Cuts and Jobs Act, did a number of years ago. So currently for 2024, where it was 100%, 2 years ago, we're down to 60%, and then next year it'll be 40%, 20%, and then 0. Is that going to stay that way? There's been a lot of things in Congress about moving it back to 100%, because they like that. It stimulates the economy and all those things. But right now, this is the law that we're kind of dealing with, so this is what we're going to plan around. So when you have an asset in those 15-year, 7-year, and 5-year class lives, then you can use this to get a bigger bang for your buck in the first year. You're still going to depreciate the remaining portion of it over that life on whatever the asset was, but in the first year, you get to get a hit for 60% of whatever that cost was. So that's a lot of how you're creating those losses. And in addition to how you're getting those class lives all broken up, when you first buy a property, you have to basically treat it as two different things. It's one asset that's going to be treated as two things likely. It's going to be land and it's going to be building. And then there's no other class lives that you're going to use. And so land is not depreciable. The building, you can go to the next slide. The building will be set over 27 and a half years for residential, 39 year for commercial. There's no bonus depreciation on that. Their class lives are higher than 20 years, and so you don't get any initial year. You just have to straight line depreciate it out over that lifetime. How do you get around it? There's this nifty little thing called a cost segregation. How many have done a cost segregation in their portfolio? I see 5 hands. All right. Does everybody knows what it is, though? You've heard of it. We just move on. Maybe. Well, for shits and giggles, we'll talk about it. All right, so I won't spill the beans too much. But okay, so cost segregations, with the cost segregation, I'll carve it into 2 different types. The first type is a full-blown cost segregation, meaning you buy a property, you do nothing to it, and you hire an engineer to come in and carve it out into all the different pieces of the building, and then you apply the class lives of depreciation that the IRS provides, and then anything under the 20 years, a 20-year life, you can bonus, and then you're also getting additional depreciation in those first years because of those assets that were classified at shorter life, okay? So that's the main one. That's the main cost segregation. You have to pay an engineer to come do it. They'll do the study, take pictures, give you a big full report. They'll usually cover you for any audit from the IRS if they come back and question their work and all of that. So, oh yes, thank you. Ted could tell I needed to wet my whistle here a bit.
What minimal size property would qualify for that?
Go ahead, can you restate that?
So what's the minimal size property that would qualify for the full, that would make it worth it?
Sure. Yeah, I mean, it's a good question because there's a cost to doing this. You're bringing somebody in, they're gonna have to run the study, they're gonna charge a fee to do that. Each property is going to be different, and you wanna make sure that whatever company you're using is reputable and will actually stand behind their work, because you may not even see anything from the IRS for 3 or 4 years before you get audited from when that cost study was actually done. And so you wanna make sure that the company's doing solid work. Which means they're not going to be a cut rate shop, and they're going to charge you a fee for that. So I would say, like, my rule of thumb, you know, and it depends on each client, but, you know, the property, the real, if I really had to, you put a gun to my head and you had to tell, I had to give you a number, you know, I'd say somewhere around 600,000 and above. Going below that, like, you will get, you know, some more depreciation in the current year, but whether you're going to be able to reduce your tax enough to make up the cost over time, it may or may not be worth it. And it's all a time value of money thing. Like this, the expense that you receive from doing this, you could have waited to receive that expense over, you know, 27 and a half years. So all you're doing is just taking the expense that would have been later on received and putting it into the current year. So you need to make sure that the reduction in tax and the savings and the time value of those dollars is worth it to what you had to pay to get that. And that's why the cost of the building that you purchase needs to be of a decent value in order to get enough out of it that it makes sense. So alternative to, you know, a full cost segregation. Oh, we have a question, yeah.
So what estimated cost am I looking at? I got $600,000 building. What estimated cost for a cost segregation study?
Well, we don't do the studies, so we're not engineers.
Right.
But from what I've seen, you're probably looking somewhere around $2,500 to $4,000.
Does it have to be done in the same year that you purchased the property?
No.
No.
And that's a great question, actually.
Okay.
So you can strategically plan when you do your cost segs. And what I mean by that is you can wait 3 years. Be like, I really need some expenses this year, and I'm not planning on buying more properties. You look at all your portfolio and be like, you know, this property I bought for $1 million. I think that we could squeeze some depreciation out of it and put it into the current year. So what that looks like, actually, you do the cost segregation, you know, 3 years later, and then you have to make some specific special elections. You know, we're always about elections. And it's an accounting method change. So you're changing the method of accounting that you originally chose 3 years ago. So you chose to do straight line depreciation over 27 years. And now you're choosing to carve it up into 6 different buckets, and you're gonna take bonus depreciation on 3 low buckets. And then it'll say, okay, well, you took this much depreciation up to this point, you should have taken X amount more, and your accounting method change, you received a tax benefit of X. And so you will, you know, part of the cost segs studies, they'll need to know that. And then a lot of them, the good ones, will actually provide you the form that you then provide to us to, you know, make sure that we're getting in there right, and we'll also check to make sure that the depreciation numbers are correct as well. Another question?
Hey there. I just want to make sure I understand bonus depreciation accurately. So you buy a $100,000 house, 20% down, it's $20,000. Your expenses on the year, I guess your mortgage, insurance, all that stuff is another 10. You can depreciate 60% of that 30.
So let's separate your question a little bit. The down payment doesn't matter. You bought an asset for $100,000. You put 20 down and you got a loan for 80. The IRS doesn't care about that piece. So
you depreciate 60% of the 100.
You will depreciate the 100,000 that you purchased, what your purchase price was, and you'll divide it into the buckets that it should be. And so, you know, if you don't do any cost seg, then you're looking at 27 and a half years. So you depreciate the 100,000 over that lifetime. I'm excluding land for this example. But if you go in and you do a cost seg and they say, okay, 10,000 of this is appliances. Okay, so appliances are 5-year life, and you can take 60% bonus depreciation on that. So you'll get a $6,000 bonus depreciation on those appliances. in the first year. And then you'll depreciate the remaining $4,000 over 5 years. And then the other, $90,000 are going to be, depreciated over their own lives. And if any of those qualify for bonus, then you can take it on those pieces.
So remove the cost seg, right?
Yep.
Just the concept itself.
Yep.
$100,000 house depreciates over 30 years.
Yep.
Or whatever. What is my 2024 depreciation amount?
It would be 100,000 divided by 27 and a half years. That'll be your depreciation number.
Okay, and then the 60%, I was trying to figure out where's the 60%
So
come in?
you don't get bonus depreciation on that house. Because the house itself, the 27 and a half years, if that's all you're depreciating, 27 and a half years doesn't qualify for bonus. So all that means is you're just gonna depreciate it over 27 and a half years, right? In order to get the bonus, that 60% bonus, you have to have a class life on that asset of less than 20 years. So let's say you're depreciating that building, the 100,000 over 27 and a half years. And then in year 3, you go and buy all new appliances and it costs you 10 grand. Well, then you'll get a $6,000 deduction in that year, and then 4,000 of it will be spread out over 5 years.
Got it. Okay, perfect.
That work?
Yep.
Cool. Whoa. Okay, so that's the full cost seg. Let's see. The mini cost seg is just something like, I should almost put like I coined it, trademarked. But I refer to this as you bought a property, so let's say you bought the 100,000 property, but then you put another $100,000 of improvements in it. Now, when you originally buy the property and you have to depreciate it over that 27 years, when you go in and you do a big renovation on it, now you have, your facts have changed, you have more information. So you can go in and take all of the different improvements that you did, and because you have the actual receipts and knowledge of every single category that would have gone into, then you can basically cost seg each one of those on the improvements, not the original purchase, just the improvements, and you can choose, which lives they're going into. Like choose, but you're gonna follow the rules, but you'll be able to carve it out into those different lives instead of just plugging it all into 27 and a half year. That makes sense? Okay. Go to the next slide. Okay, this is just an illustration. Just like if without the cost seg, maybe this would have been better. Probably should have done this when we were asking questions. Without the cost seg, you basically have two categories. With the cost seg, you have all these different categories. Some of them qualify for the bonus, and some of them don't. Okay, so we're going to move on from depreciation and cost segs unless anybody else has any other questions. Okay. So the next kind of real estate topic that we'll talk about is 1031 exchanges. Does anybody done a 1031 exchange? Okay. There's more 1031 exchanges than cost segs, okay? So basically the concept here is you're going to take a property that you've owned for a period of time. It has to be owned for at least a year and a day. And you're going to turn it into a different property. And you're gonna exchange it for a different property. In doing that, the goal is that you don't have to pay any tax in that purchase. How you are accomplishing that is you're basically taking your basis in property A and you're moving it into property B. And so it's a way of just deferring the gain. So we're not gonna recognize the gain, we're just gonna push it into the next property. There's a few things that have to occur with that. You can't receive any boot, you can't receive any cash or debt relief in that transaction. And so just think whatever loan you had in property A, the loan in property B needs to be equivalent or larger, and the cash that you would have received, if you would have cashed out completely, would have moved into property B as well. If you do that, then any gain that you had in that transaction will basically be deferred and moved over into property B. It doesn't go away, it's just pushed into the next property, and if you sell that property, that's when you will recognize the gain that was originally realized on property A. So that's kind of the concept. In order to accomplish this, it's a pretty rigid rule set, but basically you sell a property, you have to have a qualified intermediary that's going to hold the funds from that sale. You have 45 days to select the next property, and in that process, in that selection, you can choose up to 3. You can choose up to 3, unlimited value, or you could choose up to more if you specifically identify the values and how you're going to allocate the gains. That's a little bit more complicated, need a little bit more analysis, but basically the general rule is 3 properties identified within 45 days, and then you have 180 days to actually close on the properties. You don't have to close on all 3 of them. You can identify backups just in case one falls through, and then you can go to the other one, but that's basically the process. If you miss those, then you're SOL. Those dates are very specific, and so you need to make sure that you are following those. It's a pretty rigid rule. Let's see. Any questions on that? Go next slide, please. This is just an illustration of the process. The main thing I just point out is, you have to have that qualified intermediary. You can't just buy a property or sell a property and identify a property and think you're following that. There's some title companies here in town that do a nice job and will be your qualified intermediary, and they're reputable. And that is important. Like, you need a reputable company that's going to do that, because they're technically taking control of those funds. You don't have control of those funds technically, only kind of via their agreement with you. And so make sure that that company is trustworthy. Go to the next slide. As far as just planning, I think this is important. Well, it's very important. But some of the things that, like, when you're doing the 1031, like understanding why you're doing it, we're deferring gain down the road. And so if we know what our situation is now, like, sometimes it's better to go ahead and recognize the gain, I've seen. But in other cases, in some of these planning items, they really do help. And one of the things, and this is something I do see quite a bit, particularly like later in life, when you have an asset that is really appreciated and it's been fully depreciated, so the gain is quite large. In some of our estate and family planning, you will do a 1031 into maybe an asset that is easier to manage, potentially. And by doing that, you kind of get out of the hustle of one property, but you're not recognizing the gain. And you're doing that because if that person, dies, it's like, we know nobody's immortal. So if when that person dies, then they'll get a step up on basis of the asset. So sometimes the planning is we want to get out of this property, but we don't want to recognize the gain, and so we're going to push that gain over to this property, wait till mom and dad pass, and then you'll get the step up in basis on the property, and then you can sell it without any tax whatsoever. And so that's a good strategy for individuals who are older, later in life, and are looking to simplify things without actually recognizing the gain. Let's see. Some other things as far as just real estate goes. I threw this in here. Like, there's a lot of energy efficiency credits out there. Solar, You can get 30% credit on those improvements. Not necessarily worth it on like single-family homes, but maybe apartment complexes. That's possible. But outside of that credit, there's a energy efficient home credit that you can get. A lot of these go into like home builders, or if you're taking a property and renovating it and then bringing it up to energy efficient levels, you can get some credits for that. I would say this process under the new law has changed quite a bit, and so having a company that understands the new process is really important. There's things that you have to do before drywall goes up, for instance. There's some tests that you have to do and document in order to get the energy efficiency rating that you need in order to get these credits. But if you're willing to go through that process, then there's some good credits out there that you can receive. You can go to the next slide. In addition to just the credits you can receive, there's also prevailing wage. If the contractors that are doing it are meeting the prevailing wage requirements, then it actually increases those credits in that process as well. It's pretty hard to document. There's not a lot of guidance on how to go through that process currently because it's pretty new. And so just make sure whoever you're going through, is vetted and knows what they're doing, is going to stand behind the studies that they're doing for you in order to get those credits. Okay. Entity tax planning. I put this up here. This slide I found I just find it very interesting because I like to know the environment of tax. So this is just showing across the United States the benefits of, or which states are more favorable for taxes and which aren't. And so you could see, and maybe not, but Nebraska's number 30 overall. So we're in the bottom half of business favorable taxes currently. It's pretty neat. Most of those blue states that you're seeing are just, they don't have an income tax. They have sales tax and all those other things, but they don't have an income tax. Nebraska, with their state tax and sales tax, real estate tax, income tax is kind of going down, and so, but it still is ranked as one of the bottom 25 in the country. So, as far as entity tax goes, for real estate activities, when we were talking earlier about understanding how your activity for real estate is defined by the IRS when it comes to active versus passive, it's really important because it will flow down through on how you're going to be taxed on it. The main thing, if you have active income that's coming in, and that's what it's defined as, then you're going to be subject to self-employment taxes. That's 15.4%. So, if you don't want to pay that, there are certain things that you can do in order to help mitigate that, not potentially avoid it 100%, but at least get it to a manageable level that's more reasonable potentially. And in order to do that, you have to understand your entity structure and how you're holding, what you're doing with your assets, where they're running through, and all of that. This isn't legal advice or anything like that, so we don't need to talk about whether you should be an LLC, which is the most popular, I'm sure everybody's heard of, or all the other types, S Corp, Corp, partnerships, general partnerships, limited partnerships, all those sorts of things. But the LLC kind of allows you to basically pick which ones you want to be in. So if you have real estate that you're holding for long term, then really the general rule is you don't put it into a corporation, meaning you don't put it into an S Corp, you don't put it into a C Corp. The LLC status is totally different. It's really how you're taxed that matters.
But if it's a flip, you can put it in S Corp for temporary, right?
Yes, I did say long-term hold, Ted. So, yeah, you're good. So those long-term hold assets, and this kind of goes back to a number of things, but there's really two key things on why you don't do it. Don't put it into a corporation like that, because if you're long-term holding it and you're looking to get losses out of it, you do not get debt basis, meaning you cannot, if you're taking loans against the properties, those loans do not give you basis when it is in an S Corp or a C Corp. It has to be in a partnership or owned by a single member LLC or just you personally in order to get basis on the debt that you're taking out. So, real quick example, you had that $100,000 house that he was talking about earlier. You decide that you're gonna go through a program and you only have to put 2% down. Well, if you put 2% down and then are buying the rest via a loan, so $98,000 through a loan, and you have a $10,000 loss in the first year, you only get to take $2,000 of that because your basis is $2,000. You don't get to add the debt to it. So you need to be a partnership in order to do that, or hold it through a single member LLC, or just you personally in order to get that other, to get basis on the debt and be able to take losses against it. So it's important. That's reason one. Reason two, you can't move that asset around without creating a tax. So if you say, okay, I own this since it's in an S Corp and I want to put it in a different entity, you can't. You can, but if you move it out of the S Corp and move it over to a different entity, it automatically triggers a tax event. And so it's as if that asset is sold at its fair market value when you do that. And so you're going to have gain on the other side. You get to reset your basis, but that's normally not the strategy you're going with. And I'll just add one more just for fun. When you are going through the process, and let's say you're kind of older, and you do pass away, when you get that step up, when you don't hold the asset, if you hold it in a corporation, you don't get a basis step up on the asset itself, you get a basis step up on the stock instead. So that gain that's embedded inside the corporation doesn't go away when you pass, but if you owned it in a partnership or just yourself, you will get the step up directly on the asset. And so it's very important. If you have long-term hold stuff, those are the main reasons why you do not want to put it into an S Corp or a C Corp, all right? If you are doing things like Ted was talking about, you're flipping homes, you're doing more active stuff, they're all short-term holds, you're wholesaling, all of that, then you're not holding those for long-term, you're not trying to get debt basis off of them, you're not looking for a step up later, all of those things, the transferability, those things, those are no longer factors for you because you're just buying the house and you're selling it in a very short order. And so in those situations, that income that comes from those activities is subject to self-employment tax, and so you would take it and put it into an S Corp, most likely, that activity. So then the gain that's generated off of it isn't 100% fully subject to self-employment tax. Instead, you just issue yourself a reasonable wage, which can be defined in a lot of different ways, but a lot of it's facts and circumstances, in order to basically shelter it from the self-employment tax, reduce the amount that is subject to it, still pay yourself a wage. A lot of times you pay yourself a wage that also helps you become lendable for banks, which we can all kind of attribute to, but that's the type of activity when you have real estate and a real property putting inside an S Corp, that's when it makes sense to do that, when you have that sort of activity going on. Yes, so question?
Yeah, something I just thought of, that I've had some kind of thoughts with some of my clients. But, so one of the problems we have with business owners is it's hard to tax plan because it makes it harder for them to get loans from banks. Mm-hmm. So what are some things, I'm not sure how to ask this question, but what are some good tax planning tips that won't kill them for a loan, for a bank loan?
Reasonability is a big thing, honestly. I mean, minimizing your tax is one plan, but sometimes it's not reasonable. Like if your company's your LLC, your S corp is making $300,000, and you pay yourself a $30,000 wage, and then you're using real estate to offset the rest of that income. Well, that banks can't really understand all those moving pieces in that plan, but it also isn't necessarily reasonable for you to pay yourself $30,000 when you're making $300,000. And so a lot of the times, if people are reasonable with how they're paying themselves a wage, banks will look at the wage in one category, then they'll look at distributions from property and other investments in another category. And so if you can create a consistency in that and show not only the consistency of the wage, but also the consistency of the distributions that come along with it, then you will help satisfy banks' requirements and what they need in order to determine, debt-to-income ratios and how you become lendable in order to get more loans through that process. The question is who determines what's reasonable? There's a quote that I just can't think of, but basically, you know it when you see it. You know it when you see it, as far as example I provided is we're paying 10%. Nobody's going to show up to work to what you're doing to make $30,000 when in the grand scheme of things you're making $300,000. There's a reasonableness that comes along with it, and at the end of the day, you know it when you see it. And so you just have to, you don't want to be proven wrong and have to pay taxes back later on. You just need to be reasonable with it. And then if you are, then it's the IRS's job to prove you wrong and not the other way around. It's all in the plan. It's all in the plan. The question was, is there do the banks decide what's reasonable, the IRS decide what's reasonable, and how do they differ? I don't think the banks necessarily care, truthfully. But the IRS is the ones who's potentially being cheated out of self-employment taxes and stuff, and so they're the ones who probably care a little bit more. So I guess it just depends on what your goal is at the end of the day. If you wanted to accumulate more and stuff, then you might have to pay a little tax, which is, not what everybody wants to do, but it all kind of has to work into the plan and what your long-term goal is at the end of the day.
Okay, to piggyback on that, how do banks look at depreciation? Do they kind of say, okay, you have houses, we're going to get rid of that, or just not look at the lower end of your income? How do they look at that when you need a loan?
Yeah, so I'm not a loan advisor, so I'm not analyzing loans. But from what I've talked to on bankers, they'll add back depreciation, but they still include some sort of repair allowance, if you will. So they're adding it back, particularly in those years where you have a cost segregation done and you get a huge hit of depreciation. They may take that and put it more on a reasonable straight line calculation in their own system, and every single bank does this a little bit differently. But yeah, they're not going to say, well, you didn't make any money this year, so come back next year. No, they'll evaluate it, and it's not uncommon that I'll have to answer questions from loan officers on why something happened or how we're being consistent and whatnot. But each bank is a little bit different on how they analyze that. But for the most part, they do add it back. Okay. Any other questions? Okay.
I'm going to go back just a minute to the short-term rental and whether or not you're active. Is it I noticed on the overhead you had 7 days and that's average over the year. Is that based on that last case, or is that still sort of being interpreted?
So that's a little bit older rule as far as what's short term and not, and it goes to like if you're renting equipment out. It kind of goes all the way back into some of those rules and what the IRS has kind of taken from. But yeah, I mean, it's overall for the year, what's your average day? Is it less than 7 days or is it more than 7 days?
Okay, so it's still kind of a guideline if it's 20. I mean, I'm thinking about going more short-term, but a lot of it's still gonna be midterm, so I'll probably be fine
Yeah.
if I decide to go active.
Yeah, if you just manage the timelines and, you know, I think there's, midterm renters, and we've had some people come up and speak about that at times. If you put your minimum stay at 2 weeks, then you're fine.
All right,
You
thanks.
won't, yeah, cool. Okay, I don't know exactly where we're at in our slides, but let's go to the next one. Okay, so we're just, like, we've kind of covered most of this. How losses are suspended on a per entity basis, debt basis, and how that's kind of passed through on the type of entities you have. And then, you know, the saving of the self-employment tax, like the S-Corp's the one that you're gonna be paying yourself a wage. You become an employee of your corporation, so you're receiving a wage, and you get to choose your wage. It just needs to be reasonable. Reasonable. Go to the next slide, please. Okay, so part of the entity selection, we covered this quite a bit last year, but basically is the qualified business income deduction. So on any business income that's coming from a US-based business, essentially, you will get a 20% deduction of that income as long as you are satisfying a couple different things. And so you will, if you made $100,000 on your pass-through business income, and then you're only gonna pay tax on $80,000. You know, it's pretty basic for the most part. If your income gets to a certain level, then there's other kind of criteria that go into it. You could have limitations and you need to have wages at a certain point. It could be limited to that. In real estate, if you own big commercial properties, then you get to use the basis in that property by 2.5%, and that's your limitation on those. And so it all just depends on what your income is. If you go to the next slide, please. These are the income limitations for 24. Married, filing joint, 383,000. So if you're below that, then none of the limitations will come into play, and you'll just get the straight 20% on all of it.
So if you're in a REIT, do you get 20% automatically, or only your portion of the stock that you own in it?
Well, it's always based on the income that's coming from the activity. So if the K1 comes out from that REIT and it has $10,000 of income that is allocated to you, and it's not investment income, you know, all those REITs will have their own specific rules. But you'll see 10,000 of income, say, and then you'll see down in like box 20 of the partnership, it will have a code there, and it's basically like, this is the amount of income that qualifies for the QBI deduction.
Okay.
So how they determine the two, I don't prepare REIT returns, but they have their own calculations, and they'll tell you how much income that's on the K1 is eligible for the QBI deduction.
Thank you.
Okay. All right, so Ted says we have to go faster, so let's go to the next slide. We talked about this. Keep going. Okay, so we'll touch real quick. So the pass-through entity tax. So this just goes back to the TCJA, where they took away the SALT tax deduction for itemized taxpayers. So if you itemized your deductions on your personal return, then you're able to take a SALT, a state and local income tax, deduction, it is now limited to $10,000. Being in Nebraska, and you saw the chart previously, we're paying a little more tax than half the country or more. So we're hitting that limit through real estate taxes, through income taxes, and so forth. And so we're stuck at the 10,000. What this does is if you have a pass-through entity, so a partnership or an S corporation, you can make an election at that entity level to pay your Nebraska tax or Iowa tax. You know, every state has their own little process, but basically most of them have it now at this point. But you can pay the tax at the entity level. You'll get a federal tax deduction for it, and then you will get a credit on your Nebraska return for the taxes that were paid from that entity. So basically, you're paying the tax at the entity level to get a federal tax deduction, and then you don't pay that tax on your personal return. The income will be there, but you're getting a credit for the tax that was paid, and then it'll offset it. And so it's just a way of a workaround to the $10,000 limitation. Now, Nebraska, provided a 5-year look-back rule, so you can make an election to pay the last 5 years' taxes of that entity, either last year, this year, or next year. You can pay that tax, get a dollar-for-dollar credit that comes back to you, and you're basically paying back taxes. So you're getting a big tax deduction federal. You get all the money back on your personal return for the taxes that were paid. And so it's a pretty good deal. We have some clients that we do some planning on, and a lot of it's like cash flow planning, because you're basically saying, I'm going to pay my Nebraska taxes for the last 5 years, but you won't get that cash back immediately. So a lot of the planning is okay, we'll pay that in the last week of December, and we'll try to file your returns as soon as possible, so then we can get you the refund from paying that tax and reducing your federal taxes, and we'll get you that Nebraska credit and the refund back as soon as we possibly can. But it takes time. Any questions on that? Okay, we'll keep going. I was really hesitant to talk about this. Yeah, but just because small business, this is a reporting, the BOI reporting, beneficial ownership interest reporting. You have to do it. Unfortunately, we're not able to help you as CPAs, so your attorney do it, or you can go on to fincin.org and follow the directions. It's not difficult for a lot of small business owners. If you own your LLC outright, or you and your wife or whatever, then it's super simple to go through. But you have to do it by January 1st. The penalties are $500 a day. And then there's some civil fines and potential jail time and whatnot that goes along with it. So not great. There's a federal court case through Alabama, I believe, that's being challenged. It's challenging this. Who knows what's going to happen? I was at a conference. I think they said that of all the businesses in the United States that are supposed to do this, only 30% have done it through the middle of November. And so there's a huge percentage of businesses that have not done this. Who knows if they're going to provide some relief? I don't know. I just know what the law is right now. I can't say what they're going to do, but it's not that hard to do. Just go to fincin.org, crack a beer, put your information in for your LLC, and move on. You only have to do it once, and anytime things change, you have to update it within, I believe, 60 days of the time that the information changed. So you change ownership, you change address, and so forth. You have to change it. You go to the next slide. Let's go again. Okay, so I threw some gift tax stuff, some gifting up in here because it seems to be confusing at times. But basically, anybody can gift anybody else in 2024 $18,000. And so a lot of times it's like parents gifting to kids. And so, say a mom can gift to her daughter $18,000 and to her son-in-law $18,000, and to a random stranger on the street, 18,000. And it does not require any reporting. You don't have to file any gift tax returns if you stay under this limit on a per individual basis, and so you're good. Go to the next slide. If you go above the 18,000, then you fall in your lifetime exemptions. This is where you have to file a gift tax return, but all it does is just reduces the amount of your exemption that you have for your lifetime. That exemption fluctuates, and so years and years ago, it was $1 million per individual, and now it's grown all the way to $14 million. So next year, it'll be right shy of 14 million. But in 2026, the provision is set to sunset, and it will cut that amount in half on 1/1/2026. So if you are wealthy and have a lot of properties and are looking for estate planning, I suggest getting a good attorney and coming to see us where we can help you kind of plan for that. But this is kind of what we're dealing with. We don't know if that will be pushed off. They'll increase it, decrease it, remove it, who knows? But this is what we're working with currently. You can go to the next slide. Okay, so at the end of 2025, just thinking about next year, a lot of the provisions, the Tax Cuts and Jobs Act, they were under a reconciliation bill, which basically means they will go away at some point. And so the main things, our tax rates are going to change. The standard deduction that they've doubled it basically. That will actually go down, so there will be a lot more itemized filers. The SALT limitation, that goes away, and so now you can, itemize anything above that. We'll have to deal with AMT, alternative minimum tax in those situations. So all that fun stuff comes back into play. They removed, the miscellaneous itemized deductions. They removed all those on your personal return. Those will all come back. And so just lots of different changes, different angles to kind of think through. But through 2025, there's no expectation anything will change. So we'll just keep the party going for now. A few things that'll come back. So there's our top tax bracket there, 39.6. Itemized deductions will come back. There's some dependency exemptions and stuff. The one thing that does go away, and I didn't mention it from the last slide, but that QBI deduction for the 20% of business income, that goes away, which will be really interesting on how they navigate that, because a lot of the reason with that is to kind of normalize the tax between C corporations and S corporations, pass through, and all the small business owners, trying to provide something that equalizes those taxes, because they took corporate taxes, and this is a permanent change, so it doesn't go away, but they took it from 35% down to 21% flat. And so that changes the dynamics of the type of entity you would choose, because now you're paying more tax if you are on one side versus the other. And so they'll have to navigate how to fix that. So there's some other stuff. There's some R&D things that'll change and stuff like that. It's kind of a big deal to manufacturers, but not necessarily relevant to this group. You can go on to the next slide. This is just like some future stuff that our future president has talked about doing, and things that would affect us. So the bonus depreciation, that's been kind of kicked around, and wanting to move that back up to 100%. There's a lot of those TCJA stuff. So we talked about the qualified business income deduction. They're going to have to do something with that, likely extend it, put it into some different form or something. And then, the state and local tax limit, they're talking about repealing that as well. And just a lot of clean energy stuff that you're talking about, making some of those things go away or limiting those a little bit more. So,
in anticipation for this happening, is there anything that we maybe should hold off on doing because 100% depreciation is coming? I mean, most likely this is going to happen, right? You can't.
We're dealing with Congress. I don't know.
But he made it happen once. Most likely it's going to happen again. So let's just assume that that most likely has happened? Was there things that we shouldn't do right now if it was to happen?
Well, I mean, you could certainly like change the thing, like if you're doing a big improvement, like pushing it into a later year. If you do that, let's say next year we know it's at 40%, but by the time December hits, like you have a choice of putting something into service in December and getting a 20% bonus versus, and if this is like a big if, but if we know that the provision changed in January, then yeah, you would not rent that property out until January and put it in service then in order to change the criteria of when it was put in service, which makes it qualify for some of those other things.
And that's probably why it's best to meet with you as close as December as possible so we can overlook our portfolio, look at what we got going on, and then make those educated decisions, right?
There's a ton of stuff next year there's gonna be so many moving pieces. And listen, like Congress in the past has done this to us where they will make the change in January and make it retroactive. And so there's just, who knows, they could push it into the later part of 2026 even. But you just don't know what they're gonna do. You can speculate, certainly. But I think under the current or the future administration, I think it's a pretty safe bet that they're going to try to make things a little bit more friendlier to real estate individuals. And so, I think you could probably bet on that, but I couldn't tell you for sure. So let's say like next year at this time, and Ted asked me to come speak, I might be talking about the same exact stuff because they didn't tell us anything. Or we could have a whole new set of rules that we're planning for and a lot of planning opportunities on what's best, and you go from there.
We got to wrap here really quick here, but one question I have is if I'm meeting you right now, I'm coming to your office, and I'm like, hey, Jordan, I want you to look at my portfolio, and I want you to tell me, I sold 3 properties, and I'm really afraid that I'm gonna get this $10,000, $15,000, $20,000 hit. What kind of advice are you giving those people right now to make them an educated decision? Are you saying go buy a truck? Because I feel like every single person that's just a standard, I'm serious, because I feel like everybody talked to you. I was just literally at the gym today. No, I'm serious. I was at a gym today, and and he's like, my tax advisor tells me to buy a truck every year. and I'm like, you're with the wrong guy, and that was because he's like for 6 years straight I've been buying a brand new truck, and so now he's buying some of my real estate I have that I'm trying to sell off, to go a different route. But I actually gave him your number. I was like, you should call Jordan and compare. But what other advice is there besides buy a truck?
But you got to have the end in mind a little bit. Like if you were asking me, because Ted knows this, and maybe some of you do, like I am a real estate investor as well. Like I think it's awesome. It's a good diversification, does all this other cool stuff. It's all passive for me, but I make it work. But I think you have to understand that, I don't know, with me, like I want to help clients build wealth. And so buying assets that depreciate and just to avoid some tax doesn't necessarily jive in my mind. So if you have a real business purpose for it, and I'm frugal, so I'd be like, yeah, buy a used truck, at least. But yeah, still qualifies. But no, I think you got to have. I would want to know before anything, like, what's your goal? What's the end goal? Are we trying to just minimize tax just to minimize tax, or are we trying to work towards something that is more lasting? And then you go from there. But you got to have the end goal in mind.
Okay, so next question is, you have somebody in this room that says, hey, I heard if I'm an Omaha REIA member, I get a free 1-hour consult with you every year as part of my membership. Mm-hmm. And I want some true, serious advice on what I should do with my portfolio. What are you looking at? Mistakes that were made from the previous person that they're using? Like, what advice are you giving that new client? And what are you looking for specifically in their past tax documents that you're going to try to fix?
I mean, when we always go through for any new client, we want to see normally 3 years worth of returns. And there's a very specific reason for that. Like, 1, we get to know you really well. And 2, they're all open under statute. So if we see things that need to be changed, or there's a benefit there, or a risk, honestly, like we find risk just as much as benefits, but at least you will understand it and we'll be able to tell you about it. And a lot of the times, like if we're able to look through that information, we can pinpoint a lot of different things that were either missed, not seen, or we know it should be there and aren't there, so we can go through that pretty quick and look at that. Are we gonna be able to change your life in that hour?
Maybe.
Maybe,
Yeah.
but probably not. But I hope we're able to at least talk competently about your situation and provide you a couple of pointers at least.
What's the most common mistake that you're seeing with previous CPAs?
Oh, man.
With clients that you're taking over?
We obviously do a lot of real estate, so a lot of it goes into just creating a financial statement. If you're creating a financial statement, at least you know where you started and where you ended, and then you can figure out what happened in between. But a lot of times they'll just elect out of it, and so you don't even have the information to make a decision. I do quite a bit of manufacturing, and a lot of them own their own buildings, and so there's some planning opportunities there that advisors don't really take as well. And so a lot of it is, it's a lot of different pieces of the puzzle here, but Nebraskans, like, if you don't have your real estate, the property tax credit on your last 3 or 4 years of returns, then they did it wrong. I mean, there's just some low-hanging fruit that could be there. If you're self-employed and you don't have and you're paying insurance and you don't see a self-employed health insurance deduction, they miss something. So like those things, like we can look through and we can see pretty quickly just by knowing your situation, and give you some advice and tell you what to do. And a lot of times my advice is, here's the things wrong, go tell your advisor to fix it, and then come to me next year and we'll do it right.
How do you know if you've been with a CPA, or maybe you're out shopping for one after you've been with one for a while? How do you know when you've outgrown who you're working with? They're doing your books, you think everything's fine, but you don't know any different. It's like being married forever, and then all of a sudden you're in the dating pool on Tinder, and you're like, I don't know what's going on. I've heard.
Well, obviously it's not always greener on the other side, right? So I think it's good to go and at least get interview another advisor, kind of see. And listen, there are really good CPAs out there. I like to think I'm one of them, but I make mistakes too. But we go through and we'll look at the information, and sometimes it's, hey, you're in the right spot, you're doing the things you need to do. I just keep doing that. There's no reason to change in that manner. But a lot of times you'll see, particularly if you're growing, you might be with a small boutique firm, and you need more manpower, and that's where we can really come in and help. And it may be we take over anything that they do the old stuff and we do all the new stuff. We work in tandem, or we really need the whole picture, and so we just take it all over. It just kind of depends. But if you're growing, then inevitably, and if you're with a small shop, they're I don't want to be generally say, but a lot of times they're really busy, and so they just put numbers on the page and don't think about it. I like to think we think about it.
You know how if you have let's say you've been going to a family practice doctor forever, like generalist, right? And you're you've got something wrong going on inside, you need imaging done or whatever, and you trust your doctor, you know him, you've been with him for a while, but you need a specialist. Is that a thing in the tax prep world? Are there those of you running around that are just I do real estate, that's it? or is it mostly because I guess where I'm going with this is, how do you know what questions can you ask somebody that's in your field to know that they're good for you versus somebody that's maybe not up to snuff for what you're looking for?
Honestly, and this kind of sounds crazy, but before you meet with your advisor, you could go on to ChatGPT and say, hey, what are the main real estate tax things I need to keep in mind? And it'll list out some things. And if you ask them some questions, hey, have you ever thought about this? And they don't know what you're talking about, or they haven't brought it up before, then maybe you should look for a new advisor. I mean, that's like an easy thing that you could do, and you don't have to be super knowledgeable and technical about it, but you can just, it'll help you ask some just good questions that maybe you didn't know you should ask at the time.
Okay, last thing. What is the craziest thing you've ever seen somebody try to deduct?
I don't know. I don't know if I want to answer that. Well, I mean, listen, yeah. I mean, I've seen farmland being depreciated. I mean, personal homes. You see a lot of stuff from. You know, there's so many like little nuanced things, and you know, like you said, like in your question, like there are specialties in what we do. You know, in our office, I'm one of the only ones who knows enough to be dangerous on international taxation, and so like any question like that comes to me normally. But there are other things that come up on other, you know, miscellaneous stuff. But because we have such a breadth of knowledge and experience and really good clients that like to do really cool things, then we get to see a lot. And so somebody in the office likely has dealt with the situation that we're dealing with, which is really where like the bigger firm atmosphere really helps, because we work together very closely. I mean, I'll tell you, and most of my clients know this, like, I may not be the one who calls you all the time. I may have somebody else who calls you that you know does the bookkeeping or payroll, and they're going to be your connection there. But I'm going to be, you know, the technical, you know, 10,000-foot guy a lot of the times, you know. And so that's where, as a team, we really come together, and that's where a lot of value can be provided that you may not even see, but it's happening in the background. All right. I mean, I don't have anything else. You know, the Q&A things, like we've got a good team. You know, ask them questions, try and stump them. We love that. We'll come back to you. We'll do some reconnaissance, figure some things out, give you some good advice. But yeah, we're here to help. We're here to provide value. And I appreciate you listening to me drone on here this evening. So,
Give it up for Jordan Downey. Woo! Real CPA advice from a real estate investor. You should use that as your tagline on your card. Thanks, Jordan. Appreciate it, man. If you need another beer, man, go grab it. It's on us. Don't worry. I won't even send you a bill, Jordan. Okay, as we wrap up, I want to take a moment to recognize the visitors to the group. Is there any visitors in the room right now that have never been to a REIA? Can you guys raise your hand just so we know who you are? We only have 2? All right, there's more than 2. What's that? No, 3. No, now Jake, you're not a visitor. So one thing that we like to do here, or I like to do, I don't know if anybody else likes it, but I enjoy it, is that we like to find out who's in the room. So if there's something that you want to invest in, that maybe you can find somebody that's wanting to do what you do. So is it Gerard? What is it that you're, what kind of investing are you trying to get into, or what do you do? Tiny homes. I know for a fact there's somebody in here. Ben Harrell has a lot of experience with tiny homes. Or he's been, so Ben back there, tiny homes. Raise your hand, Ben. If you want to talk tiny homes, he's been working with the city on that for almost 3 years, trying to beat their butts on it. So there's a good connection for you. Speaking of, tiny homes, you should add that to the list, huh, Ben? Now we know. Anybody do multifamilies? Raise your hand high, just so we know. Where's our multifamily investors? There's only 4 in the room. Wow, 5, 6. Okay, there we go, a little better. What about single families? Anybody have single family rentals? There we go. Now the room's starting to raise up. Anyone doing mobile home parks? Any mobile home parks? I know we only get 1 or 2. Anyone working on storage units? Any storage unit owners? More hands than normal on that one. Commercial property. Anybody doing commercial property? Strip malls, things like that. And is there any contractors in the room? Oh, yeah. Contractors, are you looking for business? All the time. What kind of business? All of it. What kind of business? Commercial. What kind of business and contracting? Foundations. There we go. New foundations. Got it. Anything else, contractors? It's good to know. What about out-of-state investors? Anybody investing outside of Nebraska? Yeah? How about outside the country? Anybody investing outside the country? Tim? Tim's the one hand. Any wholesalers in the room? I know some people like to say they are or not, but I see 2 hands. Good people to know. There's a right way and wrong way to do it, so don't bash on it. Anybody doing rehabs or flipping? Anybody experience in that area? Yeah. Short-term or midterms? That's kind of my breadbasket there. Any real estate syndicators? Oh. And how about hard money or private money lenders? Yeah, our sponsor, Liquid Lending, a couple others, I see it, JM. And what about crowdfunding? Anybody doing crowdfunding? Love to pick that brain someday. Land developers, any land developers in the room? How about property managers? Jason, yeah, we've got some property managers here, good. Do you guys is anybody doing any unique property management? Like, what is there besides standard property management? You got your HOAs, you got short-term, mid-term, traditional. Is there anything else I'm missing? Not really? What's that? I'm sorry. Repairs? Nice. So, yeah, we got lots of options there. 1030 Exchange, who's got experience on that besides our accounting group over here? Our old school people in the back? Yeah. Clint, I know we call you old school because you're always here, and your face is in all the newspapers on people's tables. Please take those with you because I'm sick of handing those out, by the way, but I can't throw them away. Any real estate coaches in the room? How about realtors that do investment real estate? Okay, this is important because you want to work with realtors, investment realtors that have investments. I feel like those are the most important ones to work with. Okay, so based on what you see in the room, obviously we got a full room tonight, and one thing that is valued tonight, when Jordan speaks, our crowds are a little bit smaller, but the crowd that we have in here are the people that are more experienced and they need these types of advice, and so usually the people we have in this room are the people that have a larger portfolio, because the rookies, the people who don't have portfolios, this usually doesn't concern them. So, I like to see this group that we get in here. So take advantage of the people when we go network and have drinks, talk to these people. One thing that we pride ourselves here in Omaha is that our people will give you advice and talk to you and tell you the secrets that they have. There's no secrets. That's one thing that's been great here. You go to other REIAs around the country, and literally people have flown in, they're like they don't talk. Ram, you tell us. How many REIAs do you travel around every month? 6 REIAs you go to. Which cities? Detroit, Chicago, Grand Rapids, Kalamazoo, and Omaha. So what differentiates Omaha versus the other cities? Huge. I mean, do you find that in the other cities that they give the same information out, that people are willing to talk even amongst the members? So I'm wrong, right? He says everybody talks. So your counterpart said differently. So now I feel like an ass. So I'm sorry. He's like I'm not going to give you that one. It's like, hey, appreciate it. But yes, with that, now that I look like an ass, Ram's going to do some book giveaways here. Ram, you want to bring all those books up here? And if there's books that you don't, we grab that book on the way down. There we go. We have a lot of book giveaways. And so Ram is our not Vanna White, and he's gonna give it. But I have an app that can make you look like Vanna White. I'm serious. I have it. It'll give you the golden hair and everything. Yes. Okay. So hey, you come up here. You pick the book you want. Okay, guys. So I will hold it. You.
Christy Broadstone?
Christy Broadstone. Where you at, Christy? Okay. Christy, when you come up here, you got shout out, what do you do? Yeah, like you invest in real estate? What's your portfolio look like?
I have one door in Missouri.
In Missouri.
Yep.
Okay.
I bought in August.
You bought in August, brand new.
I'm gonna MTR it, but I haven't done it yet.
Congratulations, that's awesome.
Thank you.
Pick whatever book you want. And that's a signed copy right there. Whoop, whoop. Thank you, appreciate you coming. Okay, next one.
Kathy Hansen.
Kathy Hansen, dun dun dun. Come on down. We need, Dennis, we need special music when people come on down. Can you do that for us? You got about 20 seconds to figure that out. And she's gonna go with, and Kathy, what's your portfolio look like?
7 homes, 3 are midterm, short term.
All in Omaha?
All in Omaha.
All right, anything you're looking for in your business?
Help.
What kind of help?
Well, I don't know. With a difficult, brand new midterm, just got it on the market, and a very angry tenant, unhappy tenant. Not really at anything, just seems unhappy. So I'm like, how's this going to work? What kind of rating am I going to get? How do I get him to, give me a good rating?
It's an Airbnb.
It's an Airbnb customer.
You know what I've been doing with my Airbnbs lately? As soon as they leave, I write, and as soon as my cleaners say the place is clean, which they're usually like within the hour, I actually screenshot the rating I gave them and gave my all 5 stars. And I'm like, hey, it looks like your profile needs some more 5 stars. And I gave you an all 5-star review. I hope you do the same for me. And it's been working gloriously. So yeah, I've been doing it every time. 3 books left.
Joe Hendricks.
Joe Hendricks. Where's our music? Dun, 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 dun. Do the dance, Joe. Do the dance, buddy. You got 3 books to choose from.
Oh, man.
Joe, what's your portfolio look like today?
I've got one house that's paid for, and I need to find some lenders, and I need to get that first property to fix and flip.
Is there something that somebody in this group could provide you to find that?
Some help finding a property, yeah. Okay. Yeah, I've been.
What's your buy box?
I've been working with hard money, so that it's going to be less than 70% of whatever it is.
Does it matter what part of town?
To me, yeah, this side of like 60th Avenue, yeah.
Okay. And then price point?
Keep it under 400.
And what's your end goals with it?
Fix it, flip it.
Just move on from it.
Yeah.
And what do you like to get, like a percentage return, or like a $20,000 return, or what do you like?
I'd like to see 20 grand. Yeah.
So there's a lot of real estate investor agents here, and if they find a deal for you right now, you can get a hard money loan or cash and move on.
Oh yeah, I got hard money and cash. We can move on it.
Okay, Joe's ready to buy. Thanks, Joe. Appreciate it, man. Next one, we got 2 left. I like the quick interviews. This is kind of fun.
Jason Young.
Jason Young. Denless lost the music already. Jason, dictatorship of a woke capital or Think and Grow Rich? Okay, Think and Grow Rich. Hey, no. What do you do?
Property management. We do residential rentals, commercial properties, and HOA management. And then I also have a couple rentals, and fix and flips. Okay. So,
what are you looking for in your business? You love this, don't you?
Oh, I do. Growth. So anybody wants management, we're a small company that still we can give our personal touch. I have a small crew, so I work with the individual versus not. So.
Awesome. Thanks, Jason. You love that. Woo! Okay, last one, and you don't get to pick a book. It's given to you. And by the way, if you guys love the book that you're given, or if you hate it, regardless, put your card back in it, return it, and we'll do this again next so we have more books to give.
Gerard Backos.
Gerard, one of our sponsors from GBH Cleaning. The music adds so much more to this. It does. Dun, dun, dun. Gerard, what do you do?
I own a couple of companies. Biggest one is a cleaning company, and I'm trying to go into real estate with a co-working space. So that's what I'm trying to do.
So I've known Gerard for a few months. The joke is he joined one of my other real estate networking groups, and this guy has given me more leads in 6 months than my networking group I have been a board member on for 7 years. And that's not a lie. So great guy. I know he's very networked. And one thing that's really cool about Gerard that you want to know is he's a doctor. And he, can I tell you a story? Yeah, sure. And tell me if I'm wrong. Yeah. He's out drinking, partying with some buddies, and they made a joke. He's like, and so in that joke, he ended up building a website and said, hey, look, I got a cleaning company. And you can tell somebody else the details. And he just built a quick one-page website. 3, 4, 5 months later, he gets a lead for a huge commercial contract. He's like, well, shit, I'm going to figure this out. And then he took the lead, got the business. Now he's got so much business coming from that cleaning company that he left being a doctor because he's like, I can go back to that anytime. And then it went full all in on owning a cleaning company. And you just had a new baby. Yes. Yeah. Two what? 2 babies. 2 under 2. Yeah. Is that Irish twins? Or is that? Yeah. Oh, yeah. Almost Irish twins. Awesome, man. If you want to hear his story, talk to me. He's very interesting. He's got all the connections. So awesome. Thank you, brother. Appreciate it. Hey. Fan of Rom, you rock, man. Okay, before we go, please take a moment to take care of the bartenders. There's a bartender in the back. She actually, I just had one of her old fashions. They're really good. And I have had some bad old fashions, and actually hers tastes really nice. And they're affordable. It's not like going to Las Vegas and paying $40 for an old fashioned. So it's way better. And if you could, there's a slideshow that's going to be playing here in a minute. You could go ahead and play it for all I care. But there's some QR codes on there. One is to give us a rating on our REIA Radio podcast. We appreciate 5-star reviews when they have 1 4-star review. If you're in that room, we've been talking about you for a long time. But we appreciate 5 stars. Even if you hate our podcast, just give us a like and subscribe on any channel that you have, or if you have a whole bunch of apps on your phone, like in all the channels, we won't get mad about that. And then I literally have a pile of books, and I'm just going to give it away next month to people that give us reviews. So appreciate that. And REIA, I don't know, they changed some crazy format in Google. So if you Google Omaha REIA, we don't pop up anymore. And so you actually got to type it in and scroll down. If you could, give us a 5-star review on there. It means the world to us. We don't charge a ton of money on this. I barely make money on this, so it isn't like a profit center for me. It's about creating a networking group. But those reviews help us get us out to the public, and it's the biggest thing you guys could do for us. So I appreciate it. I appreciate you guys. This is the day I look forward to most in every month is these meetups, and because we have such a great group of people, and it just warms my heart to see all you guys come together, and I hope you guys kick ass in your real estate business, and if I can be a resource for you, please reach out to me. You guys have a blessed night. Hope to see you guys down here for drinks, and thank you to our sponsor over there, apartments.com, for taking care of the drinks tonight. Deuces.